Hello, and welcome to Chapter 3, where we're going to be talking about adjusting accounts for financial statements. I will refer to adjusting journal entries from here on forth as AJEs. So what we're going to do is revisit some of our basic accounting principles, and then we're going to learn about what we have to do on a monthly basis to adjust our accounts before we prepare our financial statements to make sure that it's in compliance with accrual accounting principles. So this is a really, really big chapter. By now you should have your tool under your belt. In other words, when I say how do you increase an asset, you know debit, and how do you decrease a liability, you say debit. So hopefully you've kind of got that under your belt, and we can move forward. So here we are taking a look at Chapter 3. So again, we're going to be adjusting the accounts. So there's 4 kinds of AJEs, and you need to get this, understand this pretty quickly, or be prepared to discuss the fact that there's 4 kinds of AJEs. And what AJEs do is help us comply with the role of accrual accounting, okay? And here they are. We're going to need to adjust our accounts for the deferred expenses. Deferral means something's happening later. We got paid now, and then the expense will happen later. Or I'm sorry, we paid an expense now, and it will happen in the future. Another word that you will see for deferral is prepaid expenses. So deferred expenses and prepaid expenses are the same thing. Also, we're going to have to adjust for deferred revenues. A revenue is when somebody pays us, but we're not going to earn the revenue until later. Deferred revenues are also called unearned revenues. And then accrued expenses is just the opposite. We actually incur the expense, but we're not going to pay until later. And accrued revenue is I've earned the expense now, but I'm not going to get the money until later. So why do we do all this? Well, as we know from Chapter 1, our year is broke down into months, or maybe 4 quarters, or maybe 2 semi-annual periods, or maybe 1 annual period. But at some time point, we have to have a cutoff and adjust our accounts to comply with accrual accounting. And of course, you remember accrual accounting is very different from cash. Cash is just when, I get money, so that's a revenue. I spend money, so that's an expense. But that's not how accrual accounting works. Accrual accounting says we comply with revenue recognition. So whenever we've earned a revenue, we have to record it. It doesn't matter when we get the cash, right? So an example is if you give me $200 for a monthly magazine subscription, and then I have to send you a magazine once a month. Have I earned all $200 of that in this month? And the answer is I haven't. I earn a little piece of it every month when I send you the magazine. So that's an example of a deferred revenue or an unearned revenue. I can't record all $200 of that revenue. Rather, I have to record the cash in the month that I got it. And then every month as I earn a little piece of it, I take that unearned revenue account, which is a liability, to revenue. Or on the other hand, I do a bunch of work for you in January, $5,000 worth of work. Let's say I'm a hydrogeologist, and I go to do a bunch of work on your ranch. And then I send you an invoice, and you're not going to pay me until February, or maybe even into March. Do I wait until February or March to record that revenue? No, I have to record it in January, right? So that's an accrued revenue. Also, expense recognition, or the matching principle, says that, hey, when you incur an expense, you have got to match it in the same period as the revenue that it helped to earn. So back to our little time chart again, same example. If I paid a lease on my building, my commercial space, let's say that I'm an attorney and I pay $15,000 for space in January, but that's for the whole next year, right? So do I want to put all that rent expense in 1 month? No, that's a deferred expense or a prepaid expense. Prepaid expense is an asset. I have to set that up as an asset, credit my cash, right? Because I wrote a check for 15 grand. And then every month, I've got to take a little piece of it out of the asset account and into the expense account that flows through the profit and loss. So adjustments are made at the end of the period. And again, here's the 4 types that we're going to be working on. Deferred expense, also called prepaid expense. Deferred revenue, also called unearned revenue. And then accrued expenses and accrued revenue. So the action has happened now and the money's going to follow. Okay, so in this first example, I paid for 24 months of, let's say, car insurance for my business vehicle. And that it started on December 1st, 2021. So when I actually bought the insurance, I debited my asset of prepaid insurance, right? Anytime you see the word prepaid, that means current asset. And I credited cash. No problem, okay? Nothing's hit the P&L, has it? It's all on my balance sheet, debit asset, credit asset. Now, we go a month down the road to the end of December, and we have got to make an AJE to recognize that we've used up $100 of that insurance. So I took $2,400 divided by 24 months. That's easy, $100 a month, right? That's how much of my insurance I've used. Now, whenever you make an AJE, please make sure to check 3 things, and that'll help you ascertain whether it's correct or not. One part of the AJE has got to impact a balance sheet account. Write this down. One part of the AJE has to impact a P&L account or an income statement account. And it can never, ever, ever touch cash. So in this journal entry, I debited insurance expense and I credited prepaid insurance. Did I use a balance sheet account? Yep. Did I use a P&L account? Yep. And did I use cash? Nope. So that is my first kind of AJE. Here's the actual journal entry. Once I've posted them to the accounts, the general ledger accounts, which again, we're just using T accounts rather than the big 6-column general ledger account that is indicated in your book. And at the end, my balance sheet shows $2,300 in the asset account. Well, that's right, because I've used up a month. And my P&L shows 1 month of insurance expense, which is correct. That will be matched against the revenue earned in that month. Okay, so the second example, I've bought a whole bunch of supplies, right? So I debit my asset of supplies and I credit my cash. And then at the end of the month, we go in and we count my supplies. Let's say I'm a mechanic and and I've used up a bunch of small auto parts that I have put into supplies. So gosh, I can't leave this amount sitting in my asset account. And I also have to recognize that I've used some of those up and they've become an expense. So I do the math. I say, what's the difference between 9,720 and 8,670? And the math is 1,050. So my AJE is to credit my asset of supplies, right? Because my asset went down. How do we make an asset go down? We credit it. And my supplies expense went up. So now I make my journal entry and I check it, right? Did I impact one balance sheet account? Yes, I did. Did I impact one P&L account? Yes, I did. Did I touch cash? No, I didn't. Okay, then I post my journal entry to my T accounts. My balance sheet shows exactly what it's supposed to. And my P&L has got an expense that complies with the matching principle for the month of December. Okay, this is another type of deferred expense, and it's a really, really special kind. It's called depreciation. Now, when you buy a fixed asset, also known as a plant asset, this can be a building, it can be computer equipment, it can be, equipment you use in your manufacturing plant, your vehicles, anything like that. These are usually higher priced items, and they're going to benefit your business for many years usually. So say I go out and buy a $250,000 robotics line. I'm not going to put that all to expense in the month that I purchase it. Obviously, it's going to help me earn revenue for years and years. So the idea of depreciation is we allocate or spread out the cost of plant assets over their useful lives. Please make sure that you understand that depreciation in the sense of accounting, accrual accounting, does not mean a decline in value. Normally when we say depreciate, it's like, oh, I bought a new car and I drove it off the lot and it depreciated. That's not what it means in from this vantage point. What it means is we're spreading the cost of the asset over its useful life. And here is the calculation. What did it cost me? $250,000. What do I think it's gonna sell for at the end of its useful life? And I think I'm gonna keep it for 10 years and it'll sell for $50,000. That's its salvage value. So, and how long do I think it's gonna last? 10 years. So 250 minus 50 divided by 10 years, I'm going to depreciate it $20,000 a year. Now, let's go see what their number examples are. So they got some equipment for $26,000. They think it's going to last about 5 years and that it's going to be worth about $8,000 at the end of 5 years. And so they're going to write it off over 5 years, which is equivalent, of course, to 60 months, right? 5 years times 12 months a year equals 60. And we are going to write it off to depreciation for 1 month, right? For the month of December. Okay. So 26 minus 8, my numerator is 18,000. And then my denominator, so if I only make an adjusting entry once a year, I divide by 5 years. But in this case, I'm making AJEs every month. So please make a note of that. You have to convert this to months if you're making monthly AJEs. So it's $300 a month. What do I debit and what do I credit? Now I'm going to introduce a new account. My debit is to depreciation expense. Obviously, that's a P&L account. It's got the word expense right in the account title. My credit, you would maybe think, oh gosh, I can just go right to the equipment account, right? Because we know we have to use one balance sheet account and one P&L account. But in this case, we use something called a contra asset. This is a new type of T account I'm introducing. Accumulated depreciation dash equipment. And you'll have one of those for each major type of asset class. Accumulated depreciation dash building, accumulated depreciation dash car, right? So you've got a contra asset that goes against your planned asset account on the balance sheet. Again, this is a contra asset. And if you're practicing setting up a T account, it's got a credit balance because it goes against assets, and assets have debit balances. So my journal entry is to debit depreciation expense and credit accumulated depreciation. And I do that every month for the 5 years that I think the equipment's going to last me. And at the end of its useful life, the amount that will be left is what I think I'm going to be able to sell it for. Okay, and here's what it's going to look like on my balance sheet. Equipment of 26,000, less accumulated depreciation. Again, that's your contra asset, equals something called book value. And again, remember, book value doesn't have anything to do with what it's worth or fair market value. Those are very different things. Okay, second major kind of adjusting entry, deferred revenues, also known as unearned revenues. This is when somebody pays you up front for something you have to do in the future. Magazine subscriptions, membership at a country club for the next year, buying passes at a ski hill or a bowling alley or for movie tickets, anything that you give a bunch of money for, I'm sorry, as a company that you receive money for, and then you've got to provide the service in the future. So in this example, the company's client paid a 60-day fee that covers the period 12/27 through 2/24. And they paid him $3,000 on the 27th of December. So the company cannot put all of that into revenue because they've only earned 5 days of it, 27th, 28th, 29th, 30th, and 31st. They've earned 5 days of the 60 days in the month of December. So when they got the cash, they book debit, cash, credit, unearned consulting revenue. Remember, what kind of account is unearned? It's a liability. You owe somebody these consulting services. So on 12/31, this is a typo, it shouldn't say 2/31, it should say 12/31. I've earned 5 of the 60 days of that $3,000. So there's the math. $3,000 divided by 60 days, I'm going to be earning $50 a day. Times 5 days in the month of December, I've actually earned $250. Here's my journal entry. I have to debit the liability because I no longer owe them those 5 days. And I have to credit revenue because I want to show that on my P&L. I have earned that. Doesn't matter when the money transfers. It matters when I've earned it. So then I check it. Have I debited or have I impacted a balance sheet account? Yep, unearned consulting revenue. Have I impacted a P&L account? Yep, consulting revenue. Have I touched cash? No. And here then is what my balance sheet looks like at the end of the year, 12/31, I issue my balance sheet, and this is now what's in my liability account. And that's exactly right, that's what I still owe them. And I've recorded my $250 of earned revenue. Accrued expenses. Again, accrual, the way I remember that is the 2 A's. Accrued expense is action first, so accrual action. Action first, money later. So what's happening here? Here I'm paying my employees $70 a day or $350 for a 5-day work week. And I actually write the paychecks every 2 weeks. So at the end of the year on December 31st, that fell on a Wednesday in this example, I owe my employee 3 days of salary, but I'm not going to pay her until 8 or 9 days down the road. Again, doesn't matter when the cash changes hands. The action has happened, the money will follow. I have to accrue an expense. So I have to hit my wage expense account or my salary expense account. And then I have to record a payable. And remember, a payable is always a liability. So I make that journal entry and then I post it. My balance sheet shows $210 of liability. I owe that to my employee. That's accurate. And my P&L shows 3 days of salary expense in December for the amount I'm going to pay her next week. And I check my journal entry. Did I hit a balance sheet account? Yep, liabilities. Did I hit a P&L account? Yep, expense. And did it touch cash? Nope. Okay, and the last type is an accrued revenue. Again, action first, money later. So here, I've earned some money, but I've earned some revenue, but I'm not going to get the cash from my client until down the road. So let's see what happened. On December 12th, Fast Forward's customer agreed to pay $2,700 on January 10th of the next year for future services over the next 30 days. So this is like a retainer. So, hey, give me $2,700 and I will work for you for the next 30 days. But when you cut me that check for $2,700, I haven't earned a penny of it yet. I actually have to have time pass to earn it. So on the 31st, how much of that $2,700 have I earned? So, and I always count this on my fingers just so that I don't mess it up, right? 12th, 13th, 14th, 15th, 16th, 17th, 18th, 19th, 20th, 21st, 22nd, 23rd, 24th, 25th, 26th, 27th, 28th, 29th, 30th, 31st. 20 days I've earned, okay? So that $2,700 was for 30 days. So I was earning $90 a day and 20 days of that has passed. So I've earned $1,800. So when they gave me that $2,700, I debited cash. No, sorry. They haven't given me any money yet. We just made an agreement. So here I am at the end of the period, and I have to recognize that I've got an accounts receivable, right? They're going to pay me in January next year. I'm closing out my books for December. I've got an accounts receivable, which is a current asset for $1,800, and I've got revenue for $1,800. I've earned that revenue, even though I haven't got cash. So again, you can see all these adjusting entries have to do with complying with accrual accounting, revenue recognition, and expense recognition. So I check it. Did I hit a balance sheet account? Yep. Anytime you see the word receivable, you have an asset, current asset. Did I hit a P&L account? Yep. Revenue. Did I hit cash? No. So when I post those, here's what I have in my balance sheet account. I have $1,800 of AR, right? Accounts receivable. And I made an adjustment for $1,800 of revenue. So what I would like you to do before you listen to the next lecture is go on to chapter 3, which I will open in just a minute here. And you'll see there's a couple handouts, handout 1 and handout 2. Before you listen to the next lecture, I would like you to go into handout 1 and answer all of these questions. And there's some little true and false too. And we'll go through those together before we, so just write all this out. Tell me what kind of accounts these are. Do your true and false. We'll go through those and then I'll lecture a little bit more. And then we'll move on to the much more demanding handout number 2. So I hope this has been helpful and that you're able to do your reading for chapter 3, work through the handout, and then I will meet you back for the second lecture. Okay, thanks. Bye.